Today, the fallout continues. The DFA Daily, the 28th of May, 2020. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Today we look at some of the continuing fallout from the economic decline that we're in the midst of. Wherever you look, you can see the signs. For example, according to The Age, a Chinese company that leased apartments to students from China living in Melbourne has gone out of business because of the pandemic, leaving behind scores of renters who have each lost thousands of dollars in deposits. Home Plus promoted itself as an experienced real estate service organisation that provides its Chinese clientele with best service, offering best quality property throughout Melbourne's CBD. But a large group of overseas students, likely more than 150 people, and some local landlords who rented their properties via Home Plus have lost money to the company, which last month applied to deregister itself and all but disappeared. The company ran a property leasing website, J1Ho, which targeted overseas students coming to live in Melbourne. It leased dozens of apartments in Melbourne's CBD Docklands and West Melbourne, and then made money by subleasing these properties to Chinese citizens coming to the city to study. The pandemic meant many Chinese students were unable to return to Melbourne from China this year, leaving Home Plus unable to pay its leases, but until April, the company kept taking rental payments and bonds from students. It never handed those bonds to Consumer Affairs Victoria's Residential Tenancies Bond Authority as required under state rental laws. The Age has been in contact with dozens of Chinese students and property owners who are angry about losing money to Home Plus. Many have lost upwards of $2,000 on the mobile phone app WeChat. A group that has 170 members have almost all lost money to the company. Home Plus is supposed to return my $3,000 bond paid to them while they are claiming they're under bankruptcy, said one Chinese student, Kathy Sun. She said, Home Plus' failure to lodge their bond with the bond authority meant I have no guarantee that my money will come back. And many tenants who've paid their rent and landlords who were meant to receive payments have been left clueless about what to do. Among the properties Home Plus released in Melbourne and then subleased to Chinese students were 23 apartments in a tower at 65 Dudley Street, West Melbourne. And by the way, central Melbourne has the highest rental stress in the country, according to my latest data. The Daily Mail reported that troubled retailer Daisy Jones is rushing the closure of some stores as it drowns in debts of $500 million, worsened by a plunge in sales due to the virus. Sales at the Australian department store dropped by 35% over March and April after the significant impact of coronavirus restrictions, Woolworths Holdings announced on Wednesday. The South African-based parent company said the downturn had accelerated plans to make huge changes to the business and revitalise the struggling brand. It is the latest Australian shopping stalwart to struggle during the pandemic, which forced thousands of stores to shut their doors in March. COVID-19 has had a significant impact on foot traffic and store sales, the update read. While online sales have grown, the company said foot traffic had not picked up when coronavirus restrictions began to ease and people returned to the shops. And the company has now appointed investment bank UBS to review the capital structure and property portfolio of the 48 Australian stores, Sydney Morning Herald reported. Restructure discussions are now taking place with landlords, with cuts expected to take place in David Jones stores across the country. We expect the challenging and fluid operating environment brought about by the pandemic to continue for the foreseeable future, the company said in its update. In these unprecedented times, the board and management team will continue to act swiftly and decisively to protect the group's financial position, and it also owns the Country Road Group, which includes Country Road, Witchery, Trendery, Mimco and Politics. UBS is planning to use the restructuring to pay off the nearly $500 million in debt owed by the Australian companies, and the company confirmed that it had a buyer lined up for the Bourke Street menswear building in Melbourne, with the sale expected to be completed by July. It's also looking at selling the David Jones flagship stores in Bourke Street and Elizabeth Street in Sydney. The drop in sales has also affected the Country Road Group, which is also owned by Woolworths Holdings, after it closed all stores when social distancing took place. The Country Road Group saw a 50.4% drop in sales between March and April, but the Woolworths supermarkets saw a 17.4% rise in sales during the lockdown, despite footfall being reduced. Demand has since moderated, with shopping patterns reflecting reduced footfall but increased average basket size, the update said. And Woolworths food businesses have been resilient throughout this period, supported by strong relationships across the supply chain. And it comes just days after retail giant Target announced 167 of its stores would close in a massive restructure as Australian shops continue to struggle in the pandemic. The struggling Australian retailer will close 75% of its stores and convert 92 others into Kmarts, it announced on May the 22nd. Following a financial review, the company revealed plans to drastically restructure as the brand suffered a $67 million sales slump. And according to the Grattan Institute blog, workers right across Australia have been hit hard by the COVID-19 shutdowns, but some electorates have been hit harder than others. They use the ABS data on the share of payroll jobs lost in each large sub-state region called a Statistical Area 4, or SA4, between the week ending the 14th of March and the 18th of April. Payroll jobs are those where workers are paid through single-touch payroll software. The data captures most workers in Australia, about 99% of employers with 20 or more workers, and 71% of employers with 19 or fewer workers use this software. Electorates with large tourism industries and a high share of hospitality workers have been hit especially hard. The two worst affected electorates are Copa at 11.6% of jobs lost and Lyne at 10.7% around the mid-north coast of New South Wales and Coffs Harbour. The third and fourth worst affected were Fairfax at 10.2% and Fisher at 10.2%, covering the Sunshine Coast in Queensland. A larger share of workers in these electorates are employed in accommodation and food services, which saw 33% of jobs lost by the 18th of April. Of the 10 worst hit electorates, 5 are in Queensland, 4 in New South Wales, and 1 in South Australia. But even those electorates least affected by COVID-19 have suffered big job losses. The outer suburban Sydney electorate of Chifley lost 4.4% of jobs between the 14th of March and the 18th of April, followed by Greenway in suburban Sydney at 4.4%, Fremantle at 4.6%, and Brand in outer suburban Perth at 4.6%. Of the 10 least affected by COVID-19, 5 are in Western Australia, 4 in New South Wales, and 1 was in the Northern Territory. Workers living in rural and regional electorates have been hit harder than workers in the major cities. 8 of the 10 hardest hit electorates are in rural and regional areas. Half of all regional electorates lost more than 7.5% of jobs between the 14th of March and the 18th of April, compared to 16% in inner metropolitan electorates and 11% in outer metropolitan electorates. 9 of the 10 hardest hit electorates are held by the Coalition, and Tanya Pliberzek's inner city electorate of Sydney, which is ranked 10th with 9.8% of jobs lost, was the hardest hit Labor electorate. 9 of the 10 least affected electorates are in inner or outer metropolitan areas, 5 of them held by the Coalition and 5 by Labor. And close to home, the Illawarra Mercury said that a major faculty restructure, which could have an impact on hundreds of jobs, is to be explained to staff at the University of Wollongong today. The move, which the Mercury understands has been approved at an extraordinary meeting of the University Council on Monday last week, would result in very significant job losses, largely non-academic professional staff. The Faculty of Law, Humanities and the Arts would cease to exist, with its component schools being absorbed into other areas. And the move will cut costs after the financial king hit delivered by the coronavirus lockdown to universities heavily reliant on international students. Staff have been largely kept in the dark, but will be told details today. The university had planned to make an announcement on Thursday, but after questions from the Mercury, rushed out a media statement on Wednesday afternoon. Lawyer and ANCORS, the Australian National Centre for Ocean Resources and Security, which focus on maritime law and security, will be merged into the new Faculty of Business and Law. And the School of Arts, English and Media, Liberal Arts and Humanities and Social Inquiry will be merged into the Faculty of Social Sciences to form the new Faculty of Humanities and Social Sciences. It appears the impact on academic jobs will be less than other professional faculty staff, administration, technical, marketing and international positions, but these job losses are likely to be significant, with some estimates above 80. The Vice-Chancellor, Paul Wellings, is set to unveil other significant changes next week at a town hall meeting. And Professor Wellings said that the faculty restructure was part of preparation for a very different higher education sector post-COVID-19. The pandemic has brought permanent, far-reaching changes which emphasise the need for universities to offer value for money, he said. And the ABC said that the owners of Mascot Towers have voted to sue the developer of a neighbouring building, claiming it was responsible for causing cracks that forced them to evacuate their homes. Last June, hundreds of residents were evacuated from the 10-storey apartment complex in Sydney's south after cracks were found in its car park. Residents were forced to find alternative accommodation, and last month it was revealed the repair bill could blow out to more than $50 million. At a meeting in Sydney last week, the Owners Corporation voted to take legal action against Ayland, the developer of the neighbouring Peak Towers. In a statement this week, the Owners Corporation claimed the cracks appeared after excavation works was conducted at the neighbouring property. That is not a coincidence, the statement read. The soil that supported Mascot Towers was removed by those constructing the Peak Towers basement, meaning that the Mascot Towers building loads could no longer be fully supported. It said it would be able to demonstrate that Ayland's shoring system at Peak Towers was underdesigned, that its piles were incorrectly built, and that waterproofing was missing or wholly insignificant. Patrick Maguire, who represents the Mascot Towers Owners Corporation, said there was strong support for the legal action. It's a complex issue and the legal action itself could take some time, but I would expect an application to the courts won't be too far away, he said. Last October, the Owners Corporation said tests revealed a loss of soil under the complex's northeast corner near the boundary of the neighbouring Peak Towers development. Ayland has always denied responsibility and earlier refused to provide Mascot Towers engineers to access the Peak Tower basement, the statement read. The meeting also discussed the potential sale of the property, but Mr. Maguire said no decision was made. We're a long way short of saying that the property will be sold, but certainly there's been approval to proceed with options to sell. The repair bill for the tower includes $32 million for rectification works and $21.5 million on a 15-year loan, and this equates to around $400,000 for each owner of the 132 units. And in more economics news, the ABS published the CapEx plan report today, and they reported a decline. They reported that CapEx spending declined in the opening quarter of calendar 2020, the fifth consecutive quarterly decline. CapEx fell by 1.6% in the March quarter, led lower by the service sector. By assets, falls were evident for equipment, down 2.3%, and building and structures, down 1.1%, and CapEx plans were scaled back for both the remainder of this financial year and for 2021. The pandemic and the unfolding recession represents a significant shock to the economy, and firms are looking to cut spending. The scale of the downgrade of CapEx plans for 2021 between their first estimate and the second estimate is the largest in the history of the series, and on this revised outlook, CapEx spend is likely to decline in 2020-21, although the scale of the fall remains uncertain, with the backdrop still fluid. Investment plans for the service sector are particularly weak, with the second estimate pointing to a 9.5% fall in 2021 after adjusting for average realisation ratios, and weakness is evident across both equipment and building and structures. In the mining sector, the emerging recovery up from the low of 2018-19 is still in place. However, the pace of the rebound has been tempered as lower commodity prices, notably for liquid natural gas, have had an impact. And if you want to see the consequences of a severe COVID lockdown, then look no further than New Zealand, where the Reserve Bank of New Zealand released its biannual financial stability report. They say New Zealand faces its sharpest economic contraction in 160 years. In New Zealand, border closures and economic lockdowns have led to an unprecedented decline in economic activity. Even accounting for an expected recovery in the second half of the year, this year's projected decline in annual GDP is the largest in at least 160 years. The associated losses in income will cause financial distress for a significant number of households and businesses, they said. And the bank also warned that the banking system resilience will be tested in the coming months. As businesses fail, household incomes fall, and house prices fall. Nevertheless, banking system resilience will be tested in the coming months. COVID-19 will have prolonged and sustained effects on some parts of the economy, and it's inevitable that some firms will fail. In the near term, pressure appears to be most acute in parts of the tourism, accommodation, and hospitality sectors, and many firms in these sectors will face longer recoveries than others as border restrictions and social distancing measures will affect sales and operating models. Compounding difficulties, firms in these sectors often hold relatively low financial buffers. Household incomes will come under pressure as staff cutbacks and firm failures lead to rising unemployment. For some households, particularly those that have high debt relative to their incomes, this is likely to lead to difficulty in servicing their mortgages, and home prices are likely to fall, although strong equity buffers as a result of loan-to-value restrictions will limit the number of borrowers who face negative equity. And loan losses for banks will rise materially from current low levels. This could weaken banks' capital positions. The Reserve Bank has recently initiated stress tests of banks to assess their resilience to a significant worsening in the economic outlook. Preliminary desktop modelling suggests that under a scenario featuring a larger increase in unemployment and a slower recovery than most severe scenarios published in the monetary policy statement, banks are likely to maintain capital ratios above minimum requirements. However, there remains considerable uncertainty about the future trajectory of the pandemic and how this will affect the New Zealand economy. Under severe enough scenarios, the viability of banks would come into question, they said. To illustrate this, a second stress scenario, broadly based on the Treasury's third worst economic scenario, assessed the impacts of a further period of economic lockdowns that resulted in unemployment rising to nearly 18% and house prices falling by almost half. Initial modelling suggests that without significant and timely mitigation actions, banks would fall below minimum capital requirements under this scenario. And meanwhile, employment data also released by Statistics New Zealand revealed that job numbers fell by a record 37,500 in April 2020. In season-adjusted terms, total filled jobs fell 1.7% in April 2020 compared with March 2020 when it was flat. April's fall is the largest in percentage terms and by number since the filled jobs series began more than 20 years ago in 1999. With the country in lockdown throughout most of April 2020, the impact of COVID-19 is now being seen in falling job numbers, Economic Statistics Manager Sue Chapman said. While a fall in filled jobs does not necessarily mean employment has ceased in all cases, we saw a rise of over 30,000 people claiming the government's job seeker support benefit in April, Ms. Chapman said. And back in Australia, Bendigo and Adelaide Bank has put away an additional $148.3 million for COVID-19 credit losses for the financial year as it grapples with the fallout from the pandemic on its customers and the economy. Bendigo said the provisions had been made after the virus crisis forced the bank to significantly adjust its base case economic outlook to include lower GDP, higher unemployment, and a fall in property prices. The bank has not assumed a sharp recovery in the adopted economic outlook, but rather a slower recovery with probabilities biased to the downside, the bank said in a statement published before the market opened today. The bank will take a $127.7 million hit to profits while increasing its general reserve for credit losses by $20.6 million, or a total of $148.3 million. Bendigo shares rallied on the news in line with the rest of the sector, adding another 25 cents or 4% to $6.54 in early trading. And Bendigo Bank Managing Director Marnie Baker said the bank had provided 20,411 retail and business customers with loans worth a collective $6.3 billion support since the virus crisis descended and began wreaking havoc. COVID-19 has demonstrated the flexibility of our organisation to adapt at scale in how we do business in line with our vision to be Australia's bank of choice, Ms. Barker said. Bendigo's portfolio of deferred loans is from the period in late March when the measures were announced until April the 30th. It includes 16,267 loans to consumers, including mortgages and personal loans worth $4.6 billion, and 4,144 loans to commercial enterprises worth $1.7 billion. The deferrals represent around 10% of the dollar value of Bendigo's mortgage portfolio, 8% of its personal loan portfolio, and 11% of its commercial lending portfolio. The forecast hit to profits compares with $870 million from NAB, $1 billion from ANZ, $1.5 billion from CBA, and $1.6 billion from Westpac. An insurer and regional lender Suncorp set aside just $133 million earlier this month by way of comparison. And the latest figures from the Australian Banking Association revealed that more than 705,000 loans have been frozen at the request of customers worth more than $200 billion. Last month, Bendigo withdrew its guidance for bad and doubtful debts for the second half, which it told the market would be within long-term averages. The bank said given the level of uncertainty created by COVID-19, the bank was no longer able to make a reasonable assessment of the impact on our credit provisions in the second half. And now here could be some rare sense from the HIA after the master builders and property council both called for significant incentives to coax first-time buyers into the housing market. The Housing Industry Association President Simon Norris said that many prospective home buyers were holding off making a purchase decision due to expectations that they will indeed receive a government grant. This view has been backed up by Tamarwood's executive chairman Robert Lynch, who is, quote, livid that people are waiting to see if there will be cash incentives before committing to buy a home from the residential builder. Our numbers were coming back to close to what it was pre-COVID, and while we're still seeing a number of people, nobody is willing to commit. They're waiting to find out what the government's going to do, Tamarwood Executive Chairman Robert Lynch told the Australian Financial Review. Everyone who was going to buy a house is saying, I'm not going to buy a house because I'm going to get $50,000 by hanging on. We're livid. For industry bodies who should understand the effect of what they're saying to come out with announcements like this is just ridiculous, he said. Tamarwood is not alone. Industry Veteran and Housing Industry Association President Simon Norris said on Wednesday other builders were also finding potential buyers were suddenly sitting on their hands in expectation of a cash grant. We're hearing that purchasers are delaying their decisions to buy or build, which is unfortunate, Mr. Norris said. It's stopping them from committing. But of course, the truth could well be that people's levels of confidence and concern about the economy are actually both influencing their decisions and they're preferring to wait. And frankly, I think it's probably a good job that they do. And finally, lest we be in any doubt, the Fed will be bond buying for many years. On May the 13th, the House Financial Services Subcommittee on Consumer Protection and Financial Institutions held a virtual roundtable with federal regulators. One of the regulators in attendance was the Vice Chair of Supervision at the Federal Reserve, Randall Quarles. At the very end of what evolved into a roundtable beset with static and inaudible passages, it was Utah Congressman Ben McAdams' turn to ask questions. McAdams' voice was sharp and crisp, and he politely said he had a question about the corporate bond buying program that the Fed was launching for the first time in its 107-year history. The exchange went like this. McAdams, do you anticipate holding these investments through the life of the purchased bond, or do you anticipate selling them at a date to be determined? Quarles, our intention is to buy and hold. That answer from Quarles effectively means that the Fed plans to keep its corporate bond buying program alive for at least half a decade. And here's how we know that. The Fed has two corporate bond buying programs, the Primary Market Corporate Credit Facility, the PMCCF, and the Secondary Market Corporate Credit Facility, the SMCCF. The Fed has released detailed descriptions called term sheets for both programs. The PMCCF term sheet indicates that the bonds it will be buying will have a maturity of 4 years or less, and the term sheet for the SMCCF states that the bonds it will buy will have a remaining maturity of 5 years or less. Since the Fed plans to buy and hold, the program will have to be alive for at least 5 years until the last of its bonds mature. But here's why the program could become much longer than that. The combined programs will start out to buy up to $750 billion worth in bonds by September the 30th of this year. Both programs say the Fed can extend that purchase period. If it's extended out over the year, then we have a 6-year program. If extended over 2 years, then we have a 7-year program, and so forth. Additionally, corporate bonds pay interest, typically every 6 months. What is the Fed going to do with that income? In the case of its other bond buying programs for Treasury securities and mortgage-backed securities, the Fed uses the interest income and maturing principal to buy, guess what? More of the same bonds. And there's every reason to believe it will do the same with the corporate bond buying program. So if the Fed is using the interest income to perpetually buy more 4- and 5-year bonds, we're looking at the potential of an infinite time frame. And remember that the mortgage-backed security program also started out to be a short-lived program. During the last financial crisis, it was launched on January the 5th, 2009, and it's still alive today, 11 years later, with $1.86 trillion on the Fed's balance sheet in mortgage-backed securities. The first leg of the Fed's corporate bond buying program began on May the 12th, with the SMCCF buying up exchange-traded funds, the ETFs, holding both investment-grade and junk bonds. In just an 8-day period, the Fed's balance sheet showed that it was holding $1.8 million in bond EFTS. The CARES Act stimulus bill allocated $454 billion of taxpayer money to be used as loss-absorbing capital to eat the first 10 to 25% of losses in the Fed's rapidly growing list of bailout facilities. The Fed will use $50 billion of that for the PMCCF and $25 billion for the SMCCF, at least for starters. Those programs will be leveraged by an approximate factor of 10 to 1 by the Fed to create a $750 billion corporate bond buying program, buying corporate bonds outright, as well as ETFs holding corporate bonds. The Fed has outsourced both programs to the New York Fed, which has in turn outsourced both programs to BlackRock, a large purveyor of investment-grade and junk bond ETFs. BlackRock will be allowed to buy up its own ETFs in proportion to its share of the market. So what could possibly go wrong? And just remember, the Fed is owned by the banks, so they are once again supporting the financial system, not the real economy. And that pretty much completes my rather sorry tale today. But I'll leave you with this question. Given all that we're seeing from the real data, then ask yourself this question: why are the stock markets running so hard? To me, this makes little sense, but hey, it is possible that it will take some time for the true colours of what's going on to shine through. And in the meantime, they are on overdrive. So expect the markets to go higher initially, but I think later they are likely to decline. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.